the only one who cannot hear Matt?
No, we also can't.
Apologies, am I audible now?
Yes, you are.
Yes.
All right, cool. Sorry about that. I don't know why sometimes Discord does that. Anyway, thanks so much, Martin, for the introduction. As already has been mentioned, my name is Matt. I'm a debater from the LSE, and I'll be talking about the IMF. Just as a couple of notes before we get underway. The first is that, the session is not actually controversial, even though it's funny. It's just that I work in political risk, and so talking about the IMF or international workshops on a public platform like YouTube can be difficult, as I'm not sure what I'm allowed to say and what I'm not allowed to say. So please keep it in the drive and keep it between yourselves. That would be great. With that being said, I'll get underway. What I'm going to be doing is I'm going to be talking the IMF. I'm going to explain what it is, what it does, what it doesn't do, and then I'm going to talk about some case studies of the IMF implementing policies, structural adjustments specifically, and then I'm going to walk through two case studies about two different IMF motions before giving you a motion about the IMF to debate. A couple disclaimers first. The first is that while I will be sharing facts about the IMF, and indeed that's the first thing in the workshop, the things I say should not be taken as gospel, in the sense that while I could make mistakes, more importantly, I'm going to be talking about the IMF as an institution as debaters talk about it. So that means I'm going to be eliding certain nuances, and I'm going to be making very broad generalizations about how the IMF functions, what it does in different countries. And I'm going to be painting with a necessarily broad brush and glossing over certain important details. So I'm completely aware that I'm going to, as a consequence of this being an hour and 10 minutes, miss.
The audio broke again, at least for me.
Yeah, your audio broke again. Sorry, Matt.
Can you hear me now? Okay, I'm not sure why, but I'll just, hopefully it stays stable. All I'm saying is, I'll try not to paint with too broad a brush and try to be nuanced enough for debate, but please understand that obviously there are always case studies that can, disprove or contradict different arguments, right? The final thing I'll note is I get told I talk fast a lot. It's probably the thing I'm actually most famous for in debating, not any achievements, so feel free to tell me to slow down at any point. Also, just give me a shout if my internet disconnects again. Hopefully it doesn't. All right, so let's start off and talk about what the IMF is broadly. Some of you probably know some of the basics already, but I'm going to talk about what the IMF actually does and how it's different from other organizations, most notably the World Bank, that have similar mandates. So you probably know that the IMF is a financial agency of the UN that's headquartered in Washington, D.C., and that the IMF functions as what's called a lender of last resort to national governments. So in effect, it's a fund that if the government of a country is in a financial crisis and can't secure funding from other sources internally, for example, through domestic banks or through some other form of bailout, the countries can then turn to the IMF for a bailout, and the IMF provides the funds, right? And when the IMF provides the bailout funds, it works to resolve what's called the balance of payments, right? So countries have what's called a balance of payments, which is the difference between all money that's going into the country at any time and the total amount of money that's going out, right? And ideally, the balance of payments should be in some kind of equilibrium, whereby outflows aren't, so much greater than inflows, right? That the government is able to make revenue from investment and from exports and not be losing so much money when businesses are taking it out of the country, right? Now, when that balance of payments becomes very out of whack, that can be a sign that the country is in an economic crisis. Often this is when the IMF chooses to step in and try to create a sort of stability, right? By giving money to financial institutions in the country or giving money to businesses in the country and so on and so forth, right? And ultimately the goal is to resolve that difference, right? The balance of payments such that it's now balanced and the country is not in a financial crisis. The other mandate of the IMF is that it works to ensure that exchange rates are stable between countries. I assume most of you are probably familiar with exchange rates, but if not, exchange rates refer to the value of one currency compared to another, right? And how much you get when you exchange that currency, right? I change my money in for euros, pounds, there's a certain rate, the pound is higher value than the euro, and so on. Exchange rate stability specifically refers to the degree to which the value of one currency compared to another remains stable over time, right? Because this is important. Currency values change, and given that currency values can change pretty, with some degree of frequency, that can lead to exchange rate instability, whereby if a country's currency value plummets all of a sudden, its currency is now worth way less on international markets, and it's very hard to turn into a different currency. currency. Now, that has implications for international trade, right? Because if your currency becomes significantly more devalued in comparison to another country's currency, maybe your exports become significantly cheaper. Or if it becomes overvalued, maybe it becomes significantly more expensive. Obviously, this is context dependent, but this is a way that this could generally happen, right? So given that that's the case, what the IMF tries to do is it tries to make sure that the exchange rates are stable and the degree to which the value of one currency, like a developing world currency, compared to another currency like the euro or the pound, remains somewhat stable. And as long as it's stable, there's a degree of consistency and a degree of trade as possible, right? The IMF was established at a conference called the Bretton Woods Conference, which also created the World Bank. If you're not familiar, the Bretton Woods Conference was a conference that hosted policymakers, bankers, international heads of state, and so on in 1944. The goal was to rebuild the international monetary system after World War II, and the establishment of the IMF specifically was to provide a backstop in the case of an economic crisis, right, that no one member state could fix. The idea was essentially that the IMF would be there as a guarantor of stability to step in when and if there was a financial crisis in a country and bail it out, right? And the IMF was established to be funded through a quota system, whereby countries contribute a bunch of different funds to a pool from which countries can borrow if they're experiencing an economic crisis or a balance of payments crisis, right? So all the international members of the IMF pay in some money, and then that money then goes to countries experiencing an economic crisis at the point at which they seek help from the IMF, right? Today, the biggest contributors are the US, Japan, the EU, Brazil, and China and India. Russia is actually still a member and has a pretty significant share of the quota, but the IMF suspended operations there since the start of the Russia-Ukraine war, so it's not super relevant for IMF debates right now. The other important thing to note about how the IMF is structured is that it doesn't have a one-person, one-vote system. And this is where it becomes particularly controversial. As you've probably heard many people make claims in this debate, we were actually talking about it just prior to the session starting, that the IMF is an institution that is run by and for white men. And there's some truth to that in the sense that because the IMF doesn't have a one-person, one-vote system, it rather weights voting in favor of depending how much money each member country gives the quota. Therefore, in practice, it means that the US, because it has the largest quota, i.e. it pays the most into the IMF, therefore has the most financial leverage over the IMF. And it has leverage in two ways. The first is that institutionally, according to the IMF's laws, the US has the most voting shares because it has the largest quota. So it has a plurality of voting shares already, right? But secondarily, it has financial leverage over the IMF because if it doesn't get its way, it can pull out its funding, and then suddenly the IMF has way less money to implement any of its policies it wants to. And therefore, in practice, the IMF often implements policies that the United States really likes, or that the West really likes more broadly, because EU countries also have a very large share. China actually has a decent share in the IMF as well. It's not one of the largest shares, despite what some people at EUDC might have you believe, but it does have a fairly large stake in the IMF, right? That being said, the IMF is slanted towards the West, right? Largely just because EU and US and these member states have significantly more voter shares and tend to vote together, right? I also included here that the IMF is headed by a managing director who's a Bulgarian, Kristalina Georgieva. So shout out Sophia Worlds, and also shout out Kristalina because I've actually met her. She's pretty cool. She talks a lot, and she talks pretty fast, maybe faster than me. But that's a fun fact. I'm not sure how useful it is for debate. Importantly
Just a
here.
heads-up note, Matt. If you have slides, we can't see them.
Sorry.
If you have slides, we cannot see them. Your screen isn't shared.
Oh, sorry. I said at the start, I don't have slides. I just wrote down this as a note.
Yeah, no worries.
Yeah, no worries at all. I didn't have time to make fancy slides. I can share my notes at the end if you guys want to see what I've written down, but it's not super detailed. I'm going off the top of my head, quite a bit. Anyway, the important thing to note that actually is useful is that the IMF is very distinct from the other institution that was established at the same time as the IMF, and that's the World Bank. So the World Bank has a similar governance structure to the IMF. I can talk about more if people have questions, but it's somewhat beyond the scope of this workshop. But the World Bank's mandate is very different. It's focused on long-term economic development and trying to reduce poverty for developing countries by giving loans and grants and technical assistance in infrastructure and education products. And these loans tend to accrue over a very prolonged period of time, right? So these are often loans that you petition when you're not in economic crisis and you end up securing while you're a relatively stable country, and then you have them for years and years and years through many different institutions. The IMF, at least in theory, is only supposed to step in as a lender of last resort, right? It's supposed to bail you out and resolve crises like exchange rate fluctuations, or resolve crises like balance of payments difficulties, or resolve crises like if there's a financial crisis and you have very little liquidity, the IMF steps in there to bail you out, right? That's the IMF's mandate. So you can think of the difference as the World Bank funds funds long-term infrastructure and development projects that are more on the social capital side. And the IMF funds specific financial and fiscal policy, financial market interventions that are aimed specifically at stabilizing economies in crisis. So short-term and crisis-oriented, that's the IMF. Longer-term and development-oriented, that's the. Now, obviously, the IMF plays a pretty big role in countries' development as well, because in resolving these crises, it pushes a lot of policy changes that then have knock-on effects that often influence the way countries develop. But the mandate of the IMF is distinct from that of the World Bank. And this is important because debaters confuse them a lot. And so if there's like one big takeaway, it's that making sure you understand that the mandate is somewhat different, and that if the motion only refers to the IMF, you're talking specifically about its mandate to do these things that I've talked about already, i.e. step in times of crisis, and not these long-term infrastructure projects. You're already, I think, a bit ahead. I've heard many debaters, for example, make arguments like, leaders will, use these long-term infrastructure projects to build roads that lead to nowhere, and kind of cross-apply the arguments about China and BRI to this arguments about the IMF. And typically, IMF funding isn't going to go to infrastructure projects in the direct sense. I mean, theoretically it can, but if it does, it's going specifically to address a short-term liquidity crisis rather than going towards some kind of long-term development project. So that's, I think, the main distinction that's kind of important to make here. So then what does the IMF actually do? How do its programs get implemented in practice? So one type of IMF program, and probably the most famous kind that you'll hear a lot about in debate, are what's called structural adjustment programs, or SAPs. And these programs are aimed at adjusting, hence the term, the country's economy, by pushing countries to adopt free market reforms. So the goal is to restore a country's balance of payments, i.e. to restore its liquidity, to give the financial institutions money, by pushing them to adopt looser market regulations to allow businesses to function better. So the IMF has a sort of ideological belief, at least many member states do, that a lot of the crises that countries experience are caused by a lack of sufficient development of the private sector. So often one big belief that IMF donor countries or IMF quota countries have, the countries that fund the IMF have, is that a lot of the big issues that happen in these developing countries is because the state has too much control over the economy. And sometimes they're right? And I'll give some examples of this in a moment. But one example might be that, say, a state has a significantly nationalized sector, like say it has nationalized all public transport, right? And therefore, there's very little competition in the public transport sector. Now imagine the state has also nationalized the energy sector or nationalized a bunch of other sectors as well. Often that leads to less efficiency because the state has, while it might be responsive to voters, is responsive in the very long term. The state might be a dictatorship and might not be responsible to voters at all. And even if it is, there's a very long time lag between voting in and out politicians and fixing policies, whereas competition between different private companies necessarily means companies are always on the lookout to improve their services to avoid being outcompeted by some other company that does. Competition also lowers prices because the more companies that are operating within the same market share, within the same space, within the same industry, the more likely it is that you can push down prices in order to try to outcompete your competitors, right? When there's a single monopoly that the state runs, there's no reason for the state to lower its prices, and the state can force out competition by disallowing or banning private competitors entirely. So what the IMF then does is it will try to use its lending power as leverage to induce specific reforms to encourage that country to deregulate its nationalized sector. So the most famous example of this, the one that you may have heard of, is South Korea in the late 1990s, right? This is the best successful case study for the IMF, right? South Korea reduced the role of the public sector in service provision. They imposed a value-added tax, and they liberalized their exchange rate. So I'll explain what that means in a moment. And what that did was it led to a reduction in the number of companies that were publicly owned and an increase in the private sector. This helped solve South Korea's balance of payments difficulties because the reason it was having difficulty finding money was because so much of its enterprises were public and were losing so much money because there was no drive to fix them, that those public enterprises became in such debt that the government was having to bail it out from other parts of its budget. What that meant was that the country itself was suffering quite a bit because the country was raising revenue from private sector and then spending it all on failing public services that didn't improve. And the private sector was becoming like, well, what's going on? We're not, seeing any improvement to our public services. Our tax dollars aren't going anywhere and being taxed at higher and higher rates to improve failing public transport as that fell into more and more disrepair, for example. As a result, the IMF's intervention here led to the public sector taking a much less large role in providing public services, and therefore you got these benefits of economic efficiency, right? Now, obviously, this in a moment, this isn't always something that works out very well, right? Often you can have inefficiencies in the private sector as well. But the ideological commitment of the IMF is to do this kind of thing, right? So there are a couple of common things that the IMF tends to include in its structural adjustment packages that are the most common things it forces countries to adopt as a condition. And it does this in two ways, right? It says first, as a prerequisite to getting money, you have to adopt these reforms. You have to say you're going to adopt these reforms, or you won't get any money from us. This is very effective because given the IMF is a lender of last resort, these countries have already failed to secure loans from most other institutions. Therefore, the IMF is like, yeah, we'll pay up, but only if you adopt our policies that we like, right? So that's really important. The second thing that's really important to note is that once they give the funding, they give it in a series of stages called tranches, right? And you can unlock tranches the more you implement, right? If you guys are familiar at all with the EU's Recovery and Resilience Plan, it's very similar to this. So the Recovery and Resilience Plan in the EU was a post-COVID plan that provided a lot of money for an energy transition for EU states to help them decouple from Russia. And depending on how much you implemented of these recovery and resilience funds, you would get more funds at the point at which you unlocked it. You can think of it in a similar vein as this, where the IMF will basically give more money, more tranches of funding at each time you implement a reform they like. The reforms are as follows. The first are spending cuts, right? I already talked about that, reducing the amount of public spending, right? The second is privatization. So public sector firms, i.e. firms that are owned by the government, like say your public transport is owned by the government, you get a private buyer, or you get many private buyers to buy them up. Another reform that's very common is labor market reforms. A lot of times these countries might have, very poor labor standards, or they might have too strict labor standards, right? Where they restrict the amount of workers that companies can employ because the labor standards are so strict, and therefore companies are afraid of either, facing backlash, or they just don't believe they can employ these people because they have to pay them too high rates, or they have to employ certain sets of people over others, like friends of the dictator or friends of his family, right? And therefore they can't hire enough people efficiently. Reforming all of that is a big part of the IMF. And finally, currency liberalization. And this is, I think, the one you guys might be the least familiar with. The way currency liberalization works is it removes what's called a fixed exchange rate and replaces it with a floating exchange rate. So the important thing to understand here is that often what countries would do prior to the IMF coming in is they would have their exchange rate to their currency set at a fixed rate. The goal of this was so when you exchange your currency, right, on international markets, you would get a fixed rate for that currency when you exchange it. So for example, say you have a Serbian dinar, for example, outside the EU, and you want to exchange that for a euro, right? If the Serbian dinar was exchanged at a fixed rate, that means that for every 1 euro, you get 12 dinars, no matter when you exchanged it over a very long period of time. The problem with this is that it's not adequately reflective of the actual economic conditions in the country. So say Serbia has an economic crisis, right? I don't know why I'm picking on Serbia, it's just an example, right? Say they have an economic crisis and suddenly the dinar is now extremely devalued within the country. If the exchange rate is fixed, that is artificially propping up the value of a currency on international markets, right? Because inside the country, the dinar can only pay for X amount of goods. It might not be able to pay for very many at all. But outside the country, it's still worth 1 or 2 euros, which is very crazy, right? Because you're basically forcing people outside the country to buy your currency at a fixed rate that's much higher than the actual value the currency has, right? So what happens often is this creates a black market for currency, right? People are like, well, why would I pay this absurd exchange rate? I'm just going to pay a much cheaper exchange rate and get more value for my money that way on a black market, right? And the problem with this then, obviously, is this leads to the currency losing even more value because now you can't even get a good exchange rate for it on international markets anymore. And nobody wants to take your currency or buy your currency at the point at which there's a much more lucrative way to do it informally, right? So liberalization allows the exchange rate to be determined by the influx of buyers and sellers on an open market.
The sound turned off again.
Sorry, can you hear me now? Hi. What was the last thing?
The last thing was this thing about the black market creation. I think you went to a new.
Okay, sorry. Yeah, I'm here. So once you have a black market created, or it might not even be a black market, right? It can be an informal market, right? Where you have markets that are not formally sanctioned by international monetary institutions, but you can still have an informal market for it, right? Means that the currency value is basically kind of screwed, right? It's just not very valuable, and therefore you can't really get good buyers on the actual market. And that's really bad because if you can't get a buyer for your currency on formal markets, you're going to have a very, very hard time participating in currency markets in general as a country. And that can be very bad for investor confidence, can be very bad for your economy. So what the IMF would often force countries to do is it would force to get rid of these fixed exchange rates and force these countries to have their value based on fluctuating rate. And the exchange rate, when it's free floating, as this is called, fluctuates based on factors like demand for countries' exports, how much investment's coming in, inflation, and so on and so forth. So that's the kind of free floating exchange rate that's very common in a lot of the developed world. So, for example, the U.S. has a floating currency, right? The dollar floats. So does a lot of other currencies, right? And the reason why this matters is because the goal of a fixed exchange rate is to basically artificially increase your country's currency values, which can seem like a good thing for a developing country in the short term, but in the long term engenders a lot of lack of confidence because of the development of these informal markets, right? And the likelihood that these don't accurately reflect the value of the country, right? So when you allow your exchange rate to float instead, it increases market confidence because buyers now know that the exchange rate will be determined by the actual material conditions in your country rather than by whatever the government says the currency is worth, which might not be very accurate, right? And the IMF imposes this conditionality in a lot of different circumstances. Sometimes they'll do some parts of it, sometimes they'll do other parts of it, right? And often the West ends up being the ones who de facto end up implementing it, which is why if you think all these conditions sound very free markety and very capitalism-pilled, it's because they are. It's because the West is determining them often. So these can be pretty controversial, right? So critics argue that these measures, such as austerity and privatization, are often very harsh, and they can actually harm the country's economy. And I'll talk about that in a moment when I get into case studies in a little bit. And critics also argue it's biased in the interest of major shareholders like the United States against the interest of developing countries. And this perceived bias can lead to a lot of resentment and resistance towards the IMF in some developing countries. So I've given you sort of the ideal form of how it's supposed to work. I'm now going to talk you through a couple case studies, and then I'm going to start doing the more debate world implications of all of the things I've said, because I realize all of this sounds a lot like, I don't know, an global econ 101 course, right? And I'm going to apply it to debate in just a moment. So there's a couple of case studies here that I think you should be aware of. The first, as I've already mentioned, is Korea. The Korean, in the 1990s, received a structural adjustment package from the IMF, and it was extremely successful at leading their economy to grow significantly. Now, Korea had already grown quite a bit. It was a very successful economy in the 1980s as well, but the 1990s and early 2000s was when it really took off. And one of the reasons why you have Samsung phones that are so popular now and so many other large Korean companies that are internationally competitive, right? Even including firms that are like electric vehicle manufacturers like Harman, or auto manufacturers like Harman, for example, which is very, in the Netherlands, very prominent as well, is owned by Samsung. And one of the reasons why this was possible was because of these reforms that were implemented by the IMF. So what were these reforms? One was financial sector reforms, as I already talked about. A big part of this was restructuring banks to make them more competitive and bring their lending practices in line with Western lending practices. So prior to this, often these banks were lending at very extremely preferential rates to companies that they had connections with. Often they would lend to domestic Korean companies at very good rates, and this would lead to, when those companies failed, the banks being unable to recuperate their debt, right? So a big part of reforming South Korea's financial sector was imposing what's called liquidity coverage ratios, meaning you had to leave a certain ratio of the amount of money you get as a bank in the bank in order to cover any crisis in case there ended up being a financial crisis that led to people withdrawing money from their banks, right? Another big measure that was implemented was trade liberalization. So South Korea got rid of a lot of tariffs that it had on goods, and in exchange, other countries dropped tariffs on South Korea. This was really good because it reduced the amount of costs that went into exporting goods, which meant that Korea could now export its goods abroad more easily, thereby reducing the degree to which trade became problematic. That's another thing the IMF really supports as well. I forgot to mention, very relevant for the current day, right? The IMF is generally very anti-tariff and very pro-free trade. It really doesn't like when countries try to do protectionist measures, like what Trump is doing right now in the US, like putting tariffs on goods. It really likes countries to be open and have free trade and have 0% tariffs or very low tariffs, right? It also reformed the energy sector in South Korea. So South Korea was very dependent on petroleum. And one of the big conditions of the structural adjustment policy was to diversify energy sources, to try to begin to get involved in the nascent renewable sector early on, and also to try to find ways to import other sources of fuel as well from abroad. And some of these were not exactly clean sources, right? You can have coal, right? Things like that. They also implemented labor market reforms. I already mentioned that. A lot of this was like making sure you had a clear standard for a minimum wage and supported the transition from a more manufacturing-based economy to a more high-tech economy. So one big problem at the time was there was a very high unemployment rate in South Korea because you had a large number of people who were being forced out of their low-skilled jobs as a result of the tech sector growing. So one big thing that the IMF program did was implemented retraining programs to get these workers who were forced out of their job into new jobs in the tech sector. So that's one of the reasons why the economy ended up becoming, I think, significantly better off as a result of these things. It also involved the government doing a lot of these, like taking a very proactive role in managing these free market reforms. So even though these were deregulation in nature, these were like forms of deregulation in nature, the government did have to intervene quite a bit in the market to break up domestic monopolies, for example, to address market failures, and so on and so forth. So it wasn't just the case of like, this is just, we're deregulating everything and letting it see how it goes. That's kind of a misunderstanding. The IMF worked very hard with the South Korean government to actually implement these policies and make sure that these things were working out. That being said, there are also failure stories, and one of the biggest failures is Zimbabwe, where the attempt to implement very similar policies, like a reduction on protectionist measures, like tariffs, for example, reform of the agricultural sector to make it more competitive and make it less dependent on people within the agricultural sector that Mugabe favored, led to a significant rise in inflation. And so what ended up happening was prices ended up going up quite a bit as a result of more companies coming in, competing, and then raising prices on the populace without their ability to do so. So what ended up happening as a result was, rather than deregulation solving the problem, it ended up creating quite a bit of inflation. And as a result of inflation, what ended up happening is that many people became quite a bit poorer. Now, none of this might have been a problem if this was just a short-term hiccup, but one of the big problems with the implementation here as opposed to the implementation in South Korea is that the government was incredibly corrupt. And so therefore there was a lot of lack of transparency in implementing its initiatives. So for example, while it did actually follow through with implementing the IMF's policies, it didn't try to message to the people very much. It just was basically like, you have to do this, you have to take this. And it never really tried to work to find workarounds for price spikes in food and electricity. So the public became very unsatisfied with its implementation. And as economic conditions worsened, rather than being able to message very clearly that things were going to get better, the government cracked down on protesters. So this led to even less investor confidence in the economy. So even if the reforms would have worked, which they might have, it ended up undermining the IMF's whole project because the government did a very bad job selling it to its people, right? Finally, the policy itself just didn't work. And the reason it didn't work was because it was very much based on the idea that if you just stopped a lot of government spending, which was happening in Zimbabwe, this would lead to a decrease in unemployment. The problem was the economy had some very poor structural dependencies. For example, it had a limited amount of ability to capitalize on its agricultural sector due to socio-political conditions in the country. That led to, when its agricultural sector began to fail, crises in other sectors as well as a result of its inability to just produce and meet tax quotas, right? So what ended up happening as a result of all of this was that you had a decline in wages and more unemployment. So the program itself didn't work. More than that, though, once it got rid of tariffs, cheap manufacturers from abroad, from the US, from China, from Vietnam, other countries, all came in and started flooding and dumping goods into the Zimbabwean market. So competition from imports destroyed a lot of nascent businesses that the government was trying to prop up. So it wasn't even just a problem of corruption. It was also a problem of, even when the government tried to implement the policies the IMF wanted to, by getting rid of the protectionist measures and by forcing austerity on the public, it ended up causing a lot of backlash. And the Zimbabwean example is actually very similar to the example of the Greek example, right, with the Greek debt crisis, because this was also structural adjustment policy in the EU. The difference there is that ultimately the Greek economy did weather the storm and did come out of it on a better side. But you can think of it very similarly, right? Initially, what ended up happening as a result of the austerity being imposed was it caused a lot of public discontent, a lot of protests, and it sent prices skyrocketing and real wages going down, right? So that's an initial problem with the austerity. And the government, in this case, Greece and the EU, managed to muddle through it because they were able to message well enough to the public that things would eventually get better, but it wasn't without problems. There were many, many protests in the early 2010s about this in Greece, and it was a very controversial policy to the point where it was something we debated quite a bit back in my day in like 2017, whether this was good or bad to implement. But yeah, Greek example, Zimbabwean example aside, the Greek example can be thought of as more in the middle, but the Zimbabwean example is a negative example of these being implemented, and the South Korean example is a positive example. So what I'm going to do now is I'm going to drop a motion in the allocations and motions channel, just so you can read it. I'll also read it out loud. And then I'm going to walk through the motion and explain how to debate it with the knowledge that I've been given. This is a motion you've been giving. This is a motion you may have seen before, and the motion has an info slide. I'm just putting it in the chat right now. Hopefully you guys can see it. During the recent economic crisis, the IMF has provided certain conditions to developing countries for receiving loans. These conditions require governments to adopt more market-based economic policies. Targets include reducing government budget deficits and increasing international currency reserves. And the policy conditions provided by the IMF include 1, reducing or eliminating fuel subsidies or fertilizer subsidies, setting the currency exchange rate to international market rates, implementing market-based interest rates, and anti-corruption provisions. And the motion is, this House believes that the IMF removing all conditions on these loans, except for explicit anti-corruption provisions, is preferable to the recent conditions in developing countries. So this motion is the Madrid World's quarterfinals in 2023. You may have seen these recordings on YouTube if you're a huge debate nerd. If not, that's also cool. It's been a few years. And there's a good amount of discourse around these specific issues in the community just because this motion gets said quite a bit. What I'm trying to say is it's kind of stock. So you're going to see it a lot, or you're going to see very similar clashes a lot. And knowing how to debate it well will help you cross-apply a lot of these things to other debates, right? So what I'm going to do is I'm going to take all of these things I've just talked about and sort of apply them to the proposition and opposition cases in the motion, and hopefully that will help you if you encounter this motion or something similar. I have another motion as well if we have time that we can talk about as well. What I'll note here is that this motion has two things right from the start that I wanted to flag. The first is I talked about a bunch of different conditions. Here, there's only 4 conditions that are noted, right? So while I've talked about a bunch of different ones, the debate is only relevant specifically to these 4 conditions because it's referring specifically to the economic crisis that was going on at the time. The second thing, and I should have clarified this first probably, is that the recent economic crisis refers to the COVID-19 crisis, the pandemic, and also refers to the supply chain crisis that was brought on by the Russian invasion of Ukraine. So for those of you not familiar, what happened after Russia invaded Ukraine was this caused a lot of disruption to energy supplies in Europe and around the world, as Russian natural gas and Russian oil is something the EU is and was and unfortunately still is very dependent on Russia for. So when the EU started sanctioning Russian oil and gas exports and making it harder to access them, this caused price spikes in commodities prices and energy prices across Europe that ended up being passed on to the consumer in the form of inflation, right, as prices for goods and services went up. So that happened. And it also ended up affecting the rest of the world, right? Because what happens in European markets also has an impact globally. So supply chain disruptions in Europe, for example, also had impacts on Africa as a result of high inflation and budgets being cut in countries, led to liquidity crises. Companies ran out of money and they couldn't invest in Africa as much as they wanted to, right? So supply chain shocks affected North African countries, affected sub-Saharan African countries, even though they aren't in Europe specifically. That's the crisis that this motion is referring to, just to be clear. I guess if you have any questions on the motion, you can also put them in the chat, and I'll get to them as well, because I'm going to talk through arguments, but yeah, if you have questions, feel free to pop in. So there's, I think, 3 broad claims on the proposition side of the debate that I think are relevant and important. And here I'm also going to talk about other major things that you hear a lot about the IMF. So obviously, I haven't talked too much about China yet. That's a huge thing in a lot of IMF debates. I'll talk about that in a minute. I'll also talk a bit more about alternatives to the IMF that aren't China, because they are relevant as well. But let's talk about the prop case, and I'll bring that up as I go. So I think there are 3 broad lines, if you're a proposition on this motion, that you want to consider. We've already talked a lot about how the IMF has, experts. It's very much in the thrall of the West, and it tends to implement policies that are, neoliberal in nature, right? So the obvious prop, if you are opposing the IMF's conditions on things, is to explain why countries are likely to do a better job determining subsidies themselves, right? And this requires you to prove the burden that often the West doesn't understand or doesn't know about the specific circumstances of a country. And therefore, when it ultimately implements these policies with conditions, it harms the economic development of those countries significantly. In other words, you want to characterize the IMF's interventions as similar to Zimbabwe and leading to the problems in these countries that I've talked about, right? For example, the IMF will implement free trade and an elimination of protectionism, but this could be very, very harmful to domestic industries and lead to that country's manufacturing products being outcompeted on the global market, right? Similarly, it might seem like a very good idea to implement competition and free market policies, but that could theoretically lead to price gouging as those companies raise prices or coordinate with one another, whereas the government might be better to have a nationalized industry, right? So these are the kind, and I'll talk about those arguments in specific in just a moment, but that's the general argument that I'm going to talk through. The second major argument from prop you can make is that countries will turn away from the IMF if you impose conditions. So if you've noticed, I talked a lot about a lot of different conditions, and they can seem very strict. What happens when you are a poor country and you don't want to be subject to these conditions? Well, you might choose a different lender. And while there are very few lenders who can compete with the IMF, one lender that could is China. And yes, China is a member of the IMF and offers money through the IMF, but China also offers its own loans at, relatively good interest rates to other developing countries as well as part of different programs, whether that's BRI or whether it's other international development programs like the AIIB, right? That's the Asian Infrastructure Investment Bank, right? So given that, there are alternatives, and China is one. The third argument you can make is that often these conditions lead to a large degree of financial volatility. And I've actually already explained this argument in the example about Zimbabwe. It's basically to say that when you implement these policies, this can cause a financial crisis, and that can be really harmful. So those are the three main claims you're likely going to make from proposition in this debate. So in terms of framing, the thing you want to explain here is that this is likely to be a tipping point for rejecting IMF loans. And this robs countries of a lot of optionality that they otherwise have to implement good policy. So the first burden under the first argument is that countries do a better job doing this than the IMF, and it's not going to be very good if they don't, is that if loans require you to give up agricultural subsidies, people are going to be very mad at you, and your government is likely to either get voted out or face a lot of protests or things like that. This happened in Egypt in, I think, 2012. I don't actually remember when they had their own structural adjustment policy. It might have been 2016. It's one of those 2 years. That's one example. And you can argue that a lot of post-colonial nations that have a legacy of colonialism would be very mad when the IMF forces you to implement these things. You can also argue that even when there are incompetent governments that do a very bad job at implementing their own policies, that often the IMF's one-size-fits-all approach is very, very harmful, and therefore countries are more liable to reject those kinds of loans. So what happens? What is the status quo, and why is that likely better? The first thing you want to prove is that often these countries are pretty competent at implementing their own policies that are beneficial. For example, one of the reasons you might provide agricultural subsidies for farmers is because farmers need that money to keep selling in the first place, especially if there was an economic crisis. And removing subsidies from farming as a result of the IMF doing these loans is likely to cause a financial crisis when the farmers are no longer able to keep selling their goods because they don't get those subsidies, right? Similarly, subsidies can often be the only growth vehicle that you have. Because if your country's economy is very stagnant, or you're just in general very poor, that can often be the thing of last resort that you have is that money. And if you take away that money and you allocate it elsewhere, even if the country gets a lot more money on net from the IMF, if the money isn't going to those specific subsidies that matter the most, say, for example, agriculture, that can lead to a crisis. And this is actually precisely what happened with Zimbabwe, right? You get rid of agricultural subsidies, you get rid of agricultural support as a result of implementing these policies, there's a crisis, right? Secondly, you can argue that being able to adjust your exchange rate is actually a good thing. So earlier I talked about how exchange rate liberalization can be good because it increases international investor confidence in your country. But what if your country is incredibly poor, and if you don't have a fixed exchange rate, you're going to just not be able to make any money on currency exchanges whatsoever? Or your currency is going to be so impoverished that basically no one wants to convert to your currency at all, right? And then the currency, you lose faith in the currency, and there's a black market for other currencies, and everything goes kind of crazy. That happens a lot in many developing countries, right? You have one of the reasons, for example, Panama uses the US dollar, I was there for World this year, is because its own currency was so depreciated, right? It had to switch to a different currency in an official sense. But often that can happen in an unofficial sense too, and that's a problem. So what you can argue is by being able to adjust your exchange rates and to fix them at a certain price, that is a benefit because it means that you are able to have an exchange rate that is calibrated to your specific economic condition. You can't do that when there's a one-size-fits-all IMF conditionality approach, right? The other thing you can say is that if a government is implementing very incompetent policies or is very bad, there's not much of a delta in the debate in general because that incompetent government will also implement IMF structural adjustment policies badly as well. So the areas where this debate is most relevant is on competent governments, right? You can also argue that capital controls, which in the info slide refer specifically to bans or restrictions on taking money out of the country, can be good because that means that you keep money in the country that would otherwise flee when there's an economic crisis, right? So basically you want to illustrate all of the ways that the IMF's one-size-fits-all deregulation approach can actually be bad for the specific developing economies that you're talking about, the ones that are reliant on agriculture, the ones with very weak currencies, the ones that are going to be most hurt by an economic crisis and therefore need capital controls in order to be implemented, right? So that's sort of the most important claim you want to make on proposition in this debate. It's avoiding that one-size-fits-all approach. The second claim you want to make, and I sort of already preloaded this one in the framing when I was talking about how this is a tipping point for governments walking away, is that you're going to have a lot of countries turn to China instead. And the argument here is that China needs to invest externally. It needs to build infrastructure elsewhere. It needs to get returns for its exports because it was struggling with financial crisis, right? And it still kind of is struggling with low growth. And therefore, Chinese loans will really be necessary for its country. So it's a very good actor to get money from. And the second argument you make is that China is likely to be just significantly worse for those countries because it might steal infrastructure. It might, for example, have a legal system that's not independent, so you can't end up prosecuting your rights there if it screws you over. And in general, it's corrupt and might not follow through on the terms of its deals, right? This is very generalist, but that's generally the arguments as to why China's bad in debating, right? So you can insert your standard analysis from your case file about why China's bad here. With that being said, the impact of this is that when the IMF removes those conditions, it's now able to make more loans. Because now countries that would otherwise turn to China now go to the IMF instead. So because there's way less conditions now, you're now able to make loans to countries that otherwise wouldn't get them, and therefore able to improve their economies better, right? So basically, the fewer conditions you impose, you're still able to give them money. You just can't impose conditions as giving on the result of giving them money, right? You can also argue that in the absence of China, they're going to turn to local banks or international creditors like loan sharks that are going to screw them over. I think this is a very unlikely scenario, but theoretically it could happen. You could have local loans from rich banks, or you could have the government expropriating money, right? Or stealing money from private banks. Both of those are really bad outcomes, obviously, because it destroys investor confidence. If the government is very broke and starts stealing the only money that's left from banks. So you could argue that that is also a bad solution. So the IMF removing conditions is very good because it stops countries from turning into this kind of country that either takes money from China, which might screw them over and steal their land, or turn to local banks via expropriation, and that can also screw over investor confidence in the country as well. So those are I think, the main reasons why turning to alternatives is likely to be worse. The final claim you can make here is the claim I made already, which I won't repeat because I've already repeated and I'm cognizant of time, is the one about Zimbabwe that I made at the end, which is when you implement these policies, they sometimes just cause financial crises in and of themselves. Because when you get rid of all tariffs, that can lead to financial crises if your country's industries aren't sufficiently developed. The reason this didn't matter for South Korea was because it already had very developed tech industry already. So getting rid of tariffs that were actually economically inefficient were very, very good for it, because then it was able to export more easily to foreign markets, and its domestic companies were already very developed, so it could compete with the other companies that were coming in. But if you have a less developed country like Zimbabwe or somewhere else, it's far more likely that you're going to be outcompeted by other countries that have much more developed industries, which is exactly what happened in the case of Zimbabwe. So that's another important thing to note, right? Different countries have different economies. The one-size-fits-all approach doesn't work. That's why it's better not to have conditions, and that's the way you make the prop argument in the debate. In terms of the op argument, there's sort of a few broad claims you can make here. The first, and I think the best claim that you can make, is that conditions allow more loans to be made in general, and more loans being made is good. And this goes back to the thing I talked about at the beginning, how the IMF has a quota system, and this quota system is specifically based on these big countries giving lots of money, right? And these big countries really want to know that their money is going to come back to them. They want to know that when they're pouring money into these developing countries, that it's actually going to stabilize them, and it's not going to cause these countries to fail further, and for there to be another financial crisis a few years down the line again, right? So therefore, what ends up happening oftentimes, if you don't have conditions, is you get less of these countries being willing to loan money in the first place. But even more than that, you are just way more likely to have the IMF just scale down the amount of lending because it wants to make sure that it's going to be successful, and the conditions are what allows it to be successful. You give the carrot and the stick approach, right? If you know your reforms are being implemented, that then allows you to unlock more money, which then leads to increase in the likelihood that eventually they're going to pay back the loan, right? So obviously, this is in the real world, it's kind of a moot point because often countries will never repay the IMF for loans, right? It's just never going to happen. But there needs to be a signal that they plan to, and there needs to be a signal that the money is going to go to a place, is going to go into doing things that they actually support, right? And the only way you get that guarantee is you actually see those reforms being implemented, and that the money being given out is linked to the implementation of those reforms. The argument is more loans being made encourages and increases the extent to which these loans are likely to be effective at implementing policies that benefit the countries, and having these conditions encourages the main contributors to the IMF to loan more money, i.e. the US, EU countries, and so on and so forth. The second argument you can make, in addition to more loans being made, is that you get good conditions, and those conditions are actually likely to incentivize positive reforms. I've already talked through the example of South Korea in quite a bit of detail, and that's a good way you can sort of cross-apply those arguments as to why those conditions are likely to be good. But specifically on this motion, which is about agriculture, for example, and getting rid of subsidies, when you reform central banks, for example, and when you reform exchange rates, that signals credibility. And credibility is really important because when you implement these reforms, it encourages the degree which foreign investors are likely to trust your central bank or are likely to trust your government, right? So when you have a fixed exchange rate, right, as opposed to one that's floating and determined by market forces, there's always a worry that the fixed exchange rate doesn't accurately reflect reality, right? If you instead allow the market to reflect it, that encourages investor confidence because now they know that the price signal they're getting is accurate. They know that what they're seeing on paper is the actual value of the currency that the market has determined. That encourages increase in investor confidence and also encourages an increase in the confidence of credit ratings agencies, everyone who supports your country's development, right? So reforms at central banks encourage these things, right? But secondarily, when you get rid of subsidies and you liberalize the economy, that encourages international investment, right? And when people come in, they build things, they develop things, they create jobs. Even if they bring in foreign workers, that still leads to money multiplier in these communities, whereby you get more money going to different businesses. Those businesses then spend the money on other businesses, and this leads to a positive cycle whereby the economy grows. And when those conditions get implemented, you also get things like safeguards on spending, whereby now these countries have to spend certain amounts of money on these reforms in order to unlock more money. They do it, and they're more likely to actually implement the programs, as talked about, right? You can also cross-apply everything I've talked about on the Korea example here as well, but just like specifically note agriculture here because the motion is about agriculture, right? In addition to all of this, you can talk about how unconditional loans or loans with less conditions are actually more likely to be risky, right? And the argument here is that often countries that accept these loans are structurally very corrupt, and if you accept these loans without the condition of reform, they're going to stay that way. Now, even if it's the case you still have anti-corruption conditions, right, which you do, right, like because the motion says you have anti-corruption conditions, the reason why structural corruption can persist for so long is because the economy is very, very poor. When the economy is poor, you're very dependent on the government, and that gives the government a huge amount of leverage over everybody else in the economy. What that then means is that the government can get away with basically whatever it wants because everyone in the public is dependent on the government for handouts, or they're going to starve, or their families will starve, so they don't really resist, right? So encouraging economic liberalization and reform is how you actually fix corruption, far more than actually just forcing the government to implement some anti-corruption reforms, which, you know, it may implement, it may not, but these economic reforms are likely to encourage actual purchasing power in people and lead to economic growth in the country more broadly. That leads to a reform from that risk. But even more than that, even ignoring political corruption entirely, all of these things that I've talked about, like fixed exchange rates and like agricultural subsidies and high tariffs and protectionism, are very, very bad for countries' economies in many instances for exactly the reasons I've talked about, right? They undermine the competitiveness of the market. They create cycles of dependency on the government and things like that. And therefore, what ends up happening as a result is that you get a system whereby these countries remain very dependent on these things for a prolonged period of time. So what that ends up meaning is that even if you get the money and even if you implement some reform, minor reform like anti-corruption reform like it's allowed on Gov, you'll just go back to doing the same corrupt practices later unless you reform the central bank, unless you reform exchange rates, unless you reform subsidies, right, and things like that. And the way you can make this very applicable to this motion specifically is by talking about agricultural monopolies. So often the way subsidies work in these countries is the government will pick and choose a few farmers it really likes and give all the money to those farmers, and then give no money to the other farmers in the country, right? And what that does then is it undermines the extent to which there's actual competitiveness in the private sector, because now monopolies end up monopolizing the market, right? And they can raise prices as much as they want. When you eliminate subsidies, now every farmer has to compete fairly, and therefore that ends up leading to a much greater degree of fairness in the market, and therefore lower prices to consumers, right? Because the subsidies also allow these companies to charge higher prices to consumers because they know the government will give them a lot of money either way, so they can just charge as many high prices as they want and don't have to pay pay their employees as much. And also, given that nobody can compete with them, they can't have their employees get stolen for another wage, right? So it creates cycles of dependency in that way as well. So the argument there is that unconditional loans create cycles of risks and lead to more volatility, right? Engagement now. How do you engage with opening government? Well, obviously, if opening government runs the claim about turning to China, you can argue specifically all of the reasons why China is bad and why often countries won't turn to China either way. But more than that, you can argue that you're actually going to be more competitive, right? Because China often offers very unconditional loans with very high interest rates. So when you have a IMF loan that now eliminates those conditions as well, it's likely that that loan is going to have to charge higher interest rates, right? Because if you don't have actual condition that says, if you don't do our policy, you're not going to give the money back, what's the only other way you can guarantee that the government will pay you back? Well, you have to charge a lot for borrowing the money, right? You have to charge very high interest rates. So the argument you can make is that what this then does is it removes the differentiation from China. What IMF conditionality does is it allows the IMF to offer loans at lower rates than China because the conditions create an additional incentive for you to pay the loan back. So in other words, this is another way you can argue you make more loans, but it's also a way you can argue that you're not going to become dependent on China either way. And that, I think, is a really useful way to respond to the prop claim on that. Now, in terms of prop, if you want to respond to this claim, right, the way you respond to this claim is firstly to explain why it is the case that you need to first characterize why it is the case that China and lenders like it are often seen as much more preferential to the West in the status quo already. So you want to characterize really hard and lean very hard on the post-colonialism claim. You want to lean very hard on the idea that the IMF is very unpopular because of colonialism, because of the West being unpopular, because of various foreign policy stances the West takes against these countries and things like that, right? And therefore, there's a very high likelihood and high interest in these countries turning to China. And that's then how you are able to unlock a lot of the benefits that you get from proposition of the potential to turn to China. You don't disagree that China is bad, right? You just say China is a very attractive option in comparison to the IMF because of all of these conditions. Only by removing the conditions can the IMF become competitive with these countries, right? So that's the way you push back on this claim from proposition, right? I'm realizing I'm running quite low on time. So I'm going to very quickly talk about a second motion, which I won't have time to fully discuss. The motion is the Euros quarterfinal from this year, which is this House believes that the IMF should declare China an intransigent creditor. And the intransigent creditor motion, it has an info slide that is the following. Under the IMF's lending policy, the IMF may declare a creditor country to be intransigent. When seeking a bailout from the IMF, a debtor country must now stop making any payments to any intransigent countries, agree not to seek any new loans from intransigent countries until the debt has been repaid to the IMF. Now, I don't have a significant amount of time to talk about this, and it's not the motion I'm going to give you all. So I will just talk really quickly and in very broad terms about what I think the core clash in the debate is. As you might realize, the debate here is going to be a microcosm of the previous debate I talked about, which is whether or not this forces countries that are in the middle of this, right, this dispute between China and the IMF, to pick a side, right? And if you're prop, you need to explain why. Even if you do this to China, other countries are still going to pick the IMF, even after the IMF does this. Because if the IMF does this, obviously China probably, if they don't leave the IMF, at the very least, they're not going to contribute very much to it anymore, right? And therefore, you need to explain why it is the case that countries that trade with both China and IMF member countries are going to pick the IMF over China. So the clash will be twofold. It will be firstly on other countries that are third-party countries to this dispute. Why do they pick the IMF? And then the second clash is on whether or not you put pressure on China to pay back its loans or moderate its bad lending behavior. The opposition claim is very straightforward. It's that China will pull funding away from the IMF and that many countries that owe debt to China are still going to be forced to pay them back. But now they pull away from the West. And as a result of pulling away from the West, you lose out on leverage over those countries in general. Therefore, it's a generally bad idea to do these kinds of things, right? So there's a lot more I could talk about on this motion. But in the interest of time, I wanted to stop here and give you guys a chance to ask. Actually, I'll say one more thing about this motion. I think this motion has some really good recorded debates online, and you can watch recorded debates on this motion and get a more detailed explanation of this clash and how to debate it. I can link some of those if people are interested in that. There's also some really good debates recorded on the Madrid quarterfinals as well. So you can also check out those on YouTube, and I think they're probably worth watching if you want to know more about the IMF. With that being said, I've now talked to you for nearly an hour, so I want to open the floor for questions, if anybody has any, before I have to head off, because I do have to head off relatively soon, unfortunately. I am technically still working, even though I'm working from home. So, I will try to keep this to like 10 minutes, but would love to offer the floor to any questions now, if anybody wants to start off. If not, that's also totally fine. I won't be offended.
2 questions, and one of them is very short, like a yes or no question. So firstly, does the IMF like only focus on policies and restructuring, or do they also give like direct cash to, for example, increase the foreign currency reserves within countries?
Yeah, they will give transfers in the sense that they'll give money that ends up being held in terms, usually in the form of US dollars. They'll give money to a foreign country that then puts it in the bank, right, at its central bank, and then it holds dollar reserves as a result. That's something the IMF would do. In terms of cash subsidies to build infrastructure, that's generally more the World Bank's purview. But yeah, to answer your question specifically, the answer is yes. They will give like money that then goes into the central bank, that the central bank then holds as a reserve, for sure. What's the second question?
Has IMF ever voted against liberalist policies?
No, not really. I mean, okay, they do in the sense that there's a lot of dispute about to what extent they implement them. But in general, the IMF usually implements more neoliberal policies, right? Because generally speaking, it believes that the inefficiencies that exist in these markets are caused by sort of a failure to embrace neoliberal reform. And a lot of the IMF's founding members and a lot of the IMF's institutional backers are really huge supporters of the free market consensus. So yes, in the sense that like they do calibrate it, right? Like the IMF has gotten better and better at knowing when to push and when to pull, right? It doesn't always implement the most extreme and most radical. That's also an argument for the debate as well. On op, you're going to want to argue why the IMF is going to not implement too strict policies, right? And why it's learned from its lessons of the past and won't be too strict. And then on prop, you're going to want to write why the IMF can't be, or say why the IMF can't be this kind of liberal, right? Why it can't be more relaxed, why it has to be very liberal, and why it has to be really harmful. So, no, it hasn't pulled back away from it, but it has moderated to an extent.
Okay, thank you.
No worries.
We have another question.
Go for it.
Is there a reason why you talk about China under the presumption that China bad and Chinese loans bad? Surely there are arguments to be made of why they can be good or even better than IMF.
100%, and you can argue that they'll be good and even better than the IMF. But the issue with the motion that I gave specifically is that it assumes that you are debating from the sort of perspective of countries receiving IMF loans, and therefore you generally want to argue from the perspective that it's good for these countries to take more loans. If you argue on this motion, the IMF removing all conditions on these loans is good because it will get outcompeted and the IMF will struggle, and then China will come in and China's good. You're probably going to lose, not because China is bad, but because if you make this argument, what's likely to happen is the other three teams are going to be like, I mean, that might be true, but presumably that's a really, really bad thing if the IMF dies or the IMF is not able to make loans, right? And if you make that concession, what's going to happen then is all the other teams will be like, okay, well, at best what you've proven is now there's only one lender of last resort. So even if China's good, right, and even if you concede to all the analysis that China's good, what you've proven ultimately on this motion then is the IMF now dies. And if not dies, at least it gets outcompeted by China. And that would probably be a bad thing even from the perspective of China good, because for those developing countries, now they only have one option, right? So no matter how good China is, China's only one country, right? It's only one lender. And having both the IMF and China is probably better. There are, of course, many arguments why China is good, right? I actually think the arguments that are made commonly in this debate are factually inaccurate, right? Like, it's not true that China does a lot of debt trap diplomacy anymore. It's not true they ever did a lot of debt trap diplomacy. It's also not true that China inherently exploits developing countries. They are incredibly beneficial as a lender, and they give lots of money to countries like Ethiopia, for example, like countries like Zambia, for example, that have saved their entire economies, right? So this is not a presumption I hold. It's not a presumption debate land holds. But on the motion that I talked through specifically, I don't think it's a good strategy to argue China good. You can argue it, but I think you are likely going to lose. I hope that makes sense in context of the question of it.
I think it makes sense, but I think exactly because of this reason that, like, there are some countries that China is good, would it be possible to avoid this issue by just saying IMF won't necessarily die because there are countries who prefer IMF and would, like, benefit from neoliberal policies. So then, like, you still get two options. It is just that the idea of having to choose between either China or EMF isn't necessarily the countries are not going to go to China because China bad, but some countries are going to go to China and that's good for them. Some countries are going to IMF and that's good for them, but like it's good that they have like still a choice.
I want you to see the motion I'm going to give before I jump into that, because the motion I'm going to give, I think, makes that argument. I think on the motion I'm going to give, that argument is something that will be talked about. I don't want to say any more than that. But what I'll say to answer that on the previous motion is I still think that's a hard argument to make, just because if your argument on prop is this makes the IMF worse at lending and therefore China becomes more competitive, I mean, you might beat CG because then CG has to be consistent with you. But I think op teams can then just very easily run a very intuitive analysis that most judges will credit, right? That just ends up taking that claim down for the same reasons I said before, right? Even if it's a more reduced version of the claim. So on that motion, no. But I think in general, yes, good instincts, right? Like I think that it's the correct claim. And I think that it's something that you want to run in IMF debates for sure. So I don't want to discourage running it. I just think in this motion, it might not be the smartest strategy. Cool. Any other questions?
I also have a question. That's okay. Oh, I think Matei also mentioned himself. Okay. I was wondering whether IMF is currently active. Like, for example, Cuba's in a financial crisis, but I haven't heard anything about them being active there, for example, but maybe I'm also wrong. So how bad does the country have to, like, be in struggle for them to be active there? And where is it currently active?
Yeah. I think that, so Cuba is under a lot of sanctions by IMF member countries, right? So that's a big reason why it isn't operating there, or if it might actually be operating there. I don't actually know off the top of my head if it is operating in Cuba. It did at one point. I don't know if it does today. But one of the reasons you probably don't hear about it very much is just because Cuba is so heavily sanctioned, unfortunately, right? It's a similar reason why the IMF doesn't operate its programs within Russia anymore, right? In terms of countries where it is active, Ukraine is probably the big one that comes to mind. Jordan and Iraq as well. Egypt still has IMF programs. Those are ones I know. There's probably more if you Google. How bad does a country need to be? Well, as you can see, those countries are very diverse, right? So it doesn't have to be so bad, right? Like I know Argentina was the recipient of a very big IMF program at one point, right? That might still be going on today. I'm not sure, but the argument is the point is you don't have to be in dire straits to get assistance, but you do have to be in a sufficient crisis that you have exhausted sort of domestic recourse, right? So typically the IMF steps in when there's a currency crisis, like the currency has become super depreciated, it's become very devalued, inflation is very high, and nobody wants to lend to the country, or the country's credit rating has tanked very heavily, or the country has just experienced like a coup, for example, like Egypt when Sisi took over, and therefore it needs a lot of money, right? So yeah, in general, pretty unstable is the answer. But obviously, as you can see, because Egypt is a stable country under a stable government, and Ukraine is a country that's currently in one of the biggest wars in the world right now, there's a very big difference between the two, right? And you can get different IMF packages depending on how much your country is struggling. Hopefully that makes sense.
Yeah, makes sense. Thank you very much.
No worries. Anybody else?
I wanted to ask about, you kind of answered this, but just to clarify, were there ever any unconditional bailouts, like for U.S. allies or for experimenting with like new measures or whatever, or have they never done that?
I don't know off the top of my head if they've ever done an unconditional bailout of a country. I don't believe they have. You'd have to probably check that. But I do know that typically they don't, for the reasons I've said. And typically it's not something that they would want to do. Structural adjustment policies, they're certainly not. Structural adjustment policies always come with conditions. I'm not sure if they've ever given a bailout to some country on a random basis with no conditions, though. But as far as the policy I've talked about, they always come with conditions.
So,
Thank you.
Sorry. When talking about privatization of previously nationalized sectors, how can we sufficiently prove competition on local level, especially in the context of states that have been previously corrupt and have probably allowed the formation of oligopolies or monopolies?
Yeah, that's a really good question. And there's a couple of ways you can prove it, right? One is the way I explained in the agriculture example, but I'll go into a bit more detail because I was a bit unclear on it. What I think you say is, first, often the way these states prop up their monopolies, right? Like, even if it's not nationalized, right, is through subsidies, right? And if it is nationalized, the state is literally paying for this company to function, right? And have shareholders and things like that. So even if the company is loss-making, the state is always bailing it out, right? This creates two problems, right? One, the moral hazard in that the company can be operated in however poorly it wants to because it always knows the state will bail it out. And two, even if the company is private, it has connections to the government, and therefore it ends up getting a lot of support as a result of those kinds of things. What you say as a result, then, is what privatization does specifically is two things. First, it encourages international investors to come in that are bound to much higher standards, right? International investors can be sued in arbitration courts around the world and are often accountable to the laws of countries that govern them outside the specific country. So, for example, if I'm a UK company, I want to invest in, like, Kosovo, for example, I want to invest in Egypt, I'm still bound to UK law, right, surrounding investments. And individual actors in that country can take me to arbitration if I don't do it, right? There are a lot of lawyers and legal NGOs and watchdogs that specifically work on an international level to find abuses of these sorts by international companies and bring them to court, right? right? So you want to avoid that from happening, and because you want to avoid that from happening, you tend to move in a positive direction in terms of implementing good policy. But secondly, even if you don't bring in international investors, even at the local level, you rob the government of its biggest ability to interfere with the market, right? Because once you privatize the sector, the process of privatization necessarily has to be done without government interference. Because if you just allow the government to interfere and pick the winner, the government will just pick its closest friend or the oligarch or businessman who he's closest friends with, and then appoint him to be the most powerful position, right? And as a result of that, what then ends up happening is, well, you have a private company now, but it's still basically under the control of the government, right? So what you have to argue if you're in favor of privatization is that the process of privatization necessarily includes checks against state interference, and therefore is likely to lead to companies having to compete on an even playing field. Now, obviously, there are very good counter-arguments to this, and this is one of the reasons why privatization often fails. IMF-backed privatization in Russia failed catastrophically for the exact reason that when you privatize a lot of previously Soviet-owned, state-owned enterprises, that money went to oligarchs specifically, who took all that money, privatized the companies, raided them and took a ton of money away from them, and led to really inefficient companies that were still basically under the control of the state, but were nominally private and now under the control of an oligarch rather than under the control of Yeltsin or whoever, right? So that is the counter-argument, right? So you have to try to argue or prove that internationals coming in creates a more equitable playing field, and you also need to try to prove that the government will be forced to stay out of the privatization process, because if it interferes with the privatization process, it's violating the terms and conditions of the loan. Otherwise, you're likely going to get beaten by the opposing claims. But with that being said, you're correct in pointing out that often these things just go poorly structurally. And here I think the motion that I talked through in general is a bit better for opposition, because I think in general these policies are actually good for a lot of countries. But here's a really good example of why that often is bad, right? Why privatization can go really wrongly. And so the issues you flag with privatization are 100% correct. I just gave you what my response would be in a debate, if I got that. Hopefully that makes sense. I think I'm out of time. Sorry. I think I'm out of time now, actually. It's now 7:10. I'm really sorry, Martin. I went right up to the edge, but I'll give the motion now, and you guys can jump into the debate.
Can you wait with the motion? And Matt, can you give me the motion through DM? Then we can take a 5-minute break with everyone here, and then I can announce the draw and then the motion, but you don't have to stay for that. But then...
yeah, I'll text you on Facebook.
Yes,
I'll text you on Facebook right now.
Well, let's give it up for Matt. That was a really good workshop. Thanks a lot.
Thank you.
Thank you.
Okay, cool. So I have a draw ready. Let's take 5 minutes, then I will show the draw, and then we'll start the debate with the motion I got from Matt. I received it, Matt, so we're all good. Thanks a lot again.
Cheers, good luck, have fun.
Cool. I need a few minutes to put stuff on a PowerPoint presentation, so